Good morning, my name is Eduardo Pascual and I'm a student at IE Business School, and today I'm here to present you my recommendation on eBay and how you should really take into account the opportunity cost of not investing somewhere else. So eBay was formed in 1995 and 3 years later they did their IPO, so they're listed on the Nasdaq. The company is the global leader in online payments, and in fact they bought PayPal in 2002, and PayPal is key now for eBay in terms of bringing revenues to the company. We're going to start by taking a look to the CFRY from the time that the company went public up until 2006, where it reached its maximum return on capital or its peak in value generation. CFRY is determined by both the operating margins and the asset turns. And we can see how from 98 up until 2006, the EBITDA margin quadrupled from 10 to 40% of its revenues. And if we take a look at the asset turns, we can see the same pattern. The asset efficiency increased from 0.22 to a maximum of nearly 0.95, which means that for every dollar invested, eBay generated 95 cents in sales. Hence, if we combine these two trends, we can explain the great increase in economic returns during those 7 years. However, from the peak of 2006 up until now, the economic returns of eBay have been constantly decreasing, and the asset turns have almost halved in the past 7 years. So management should really focus on improving the efficiency of their assets. And if you look at the financial statements of the company, you'll see that sales have increased every year. However, the percentage growth in sales has decreased almost every year. It was only in 2011 when the percentage growth in sales increased again, but this was due to the whole smartphone industry growth, where people are actually now using PayPal through their phones. But it is important to consider that there's now a huge competition coming from Amazon and Google, so maintaining sales growth is going to be really hard. So there's an overall pessimistic outlook in terms of CFRY levels for eBay. This CFRY and cash flow affect the speed at which the company can self-fund its growth. So as an investor, I would remove eBay from my portfolio, even though they have outperformed the market, and I would allocate my capital in other companies within the internet service industry, such as CoStar Group, which is up 45% year to date, or Amazon. So at the end of the day, it's all about the opportunity cost of not investing in another company that will yield greater returns. And we also have to consider what's the overall trend in the market before making any decision.